Welcome to Understanding Interest Rates for Loan Officers. In this training, we'll explore how interest rates work, what factors influence them, and how to explain rate options to your borrowers effectively. Interest rates represent the cost of borrowing money. When a lender provides a mortgage loan, they charge interest as compensation for the risk and opportunity cost of lending those funds. The rate is expressed as an annual percentage and directly impacts the borrower's monthly payment and total cost over the life of the loan. Several key factors influence mortgage interest rates. The Federal Reserve sets the federal funds rate, which affects short-term borrowing costs throughout the economy. When the Fed raises rates to combat inflation, mortgage rates typically rise as well. When the Fed lowers rates to stimulate economic growth, mortgage rates generally decline. However, mortgage rates don't move in lockstep with Fed decisions. The bond market, particularly 10-year Treasury yields, has a strong correlation with mortgage rates. Mortgage-backed securities are traded similarly to bonds, and their yields influence the rates lenders offer. When investors demand higher returns on bonds due to economic uncertainty or inflation concerns, mortgage rates increase. When bond yields fall, mortgage rates typically follow. Individual borrower factors significantly impact the rate offered. Credit score is one of the most important determinants. Borrowers with scores above 740 typically receive the best rates, while those with lower scores pay higher rates to compensate for increased default risk. The difference can be substantial, sometimes a full percentage point or more. Loan-to-value ratio also affects rates. Borrowers making larger down payments, resulting in lower LTV ratios, generally receive better rates because they have more equity at stake, reducing lender risk. Loans with LTV ratios above 80% typically require private mortgage insurance and may carry higher rates. Property type matters too. Primary residences receive the best rates because borrowers are most motivated to keep those payments current. Investment properties and second homes carry higher rates due to increased default risk. Multi-unit properties may also have higher rates than single-family homes. Loan term impacts the rate as well. 30-year fixed-rate mortgages typically have higher rates than 15-year fixed-rate mortgages because the lender's money is tied up longer, creating more interest rate risk. However, the shorter term means higher monthly payments, so borrowers must balance rate savings against payment affordability. Fixed-rate mortgages maintain the same interest rate for the entire loan term, providing payment stability and protection against rising rates. This predictability makes budgeting easier and eliminates rate risk. The trade-off is that fixed rates are typically higher than initial adjustable rates. Adjustable rate mortgages, or ARMs, start with a lower initial rate that's fixed for a specific period, commonly 3, 5, 7, or 10 years. After that, the rate adjusts periodically based on a specified index plus a margin. ARMs include caps limiting how much the rate can increase per adjustment period and over the loan's lifetime. ARMs can be beneficial for borrowers who plan to sell or refinance before the adjustment period, but they carry the risk of payment increases. Rate locks protect borrowers from rate increases between application and closing. When you lock a rate, the lender guarantees that rate for a specified period, typically 30 to 60 days. If rates rise during that time, the borrower is protected. However, if rates fall, the borrower generally doesn't benefit unless they have a float-down option, which may cost extra. Discount points allow borrowers to buy down their interest rate by paying upfront fees at closing. 1 point equals 1% of the loan amount and typically reduces the rate by about 1/4%, though this varies by lender and market conditions. Points make sense for borrowers who plan to keep the loan long enough to recoup the upfront cost through lower monthly payments. When counseling borrowers about rates, focus on the total cost of the loan, not just the monthly payment. A lower rate with points might cost more upfront but save money over time. Help borrowers calculate the break-even point where the monthly savings offset the upfront cost. Discuss their plans for how long they'll keep the property and the loan. Always provide the annual percentage rate, or APR, which includes the interest rate plus other loan costs like origination fees, discount points, and mortgage insurance. The APR gives a more complete picture of the loan's true cost and allows better comparison between different loan offers. You now understand how interest rates work, what influences them, and how to guide borrowers in choosing the right rate option for their situation. Clear communication about rates builds trust and helps borrowers make informed decisions.